Gary, good afternoon. How are you?
Yeah, good, thank you, Leo. How are you?
Yeah, I'm very well, thanks, Gary. Gary, thank you for the update. Now there's increasing talk of national lockdowns by proxy, as some ministers are saying. How have the markets been over the last couple of weeks or so? And are they pointing towards anything in the same way that commentary is?
Well, the markets don't like the talk of a second major lockdown, and they wobbled quite a lot when it became obvious that France is going into another lockdown and Germany is going lockdown light, as we've called it. So there is obviously a cause for concern, because it will put pressure on certain businesses, particularly those in the travel and entertainment and catering sectors. And I feel very bad for them. It's really tough for those guys. If you've got a catering business at the moment, life must be very, very harsh. But I think that the reaction by the market has not been as bad this time round of news of potential lockdowns, and that's because the market saw what happened in March and April and would regard it as a short-term measure. So uncomfortable as it is, and whilst it will damage the economy to some extent, it's perhaps not going to be as bad as everybody thought. And as I said in my piece today, the UK showed remarkable resilience in its bounce back in mid to late summer this year.
Gary, you mentioned industries, the tech giants. They'll be enjoying this. I say enjoying this, but you know what I mean. Business is booming for them. But of course, the stocks are hellishly expensive, as you say. So you're finding some good deals around there. Can you tell us about that?
Well, it really is an interesting position to be in at the moment, because you pick the papers up and everybody is calling the market as very, very expensive. And they quote the American market, which has had a fantastic year, the S&P 500, which is the biggest 500 quoted stocks in the US. But 23% of the value of that market is made up of the big five, i.e. that's Amazon, Apple, Google, Facebook and Microsoft. And they trade on around 35 times earnings. So in other words, you're paying a multiple of 35 times the profit of those businesses for the stock. Now, to put this in context, around 20 times is reckoned to be at the top end of the limit. So 35 times is massively expensive. And as Jake put on a piece recently, you haven't had such a big concentration of expensive stocks in America since the 80s. But at the other end of the scale, you find extraordinary value. Now, as you know, we run two equity funds, and a lot of the stocks in those two equity funds are also in the multi-asset funds, and these are equity income funds. And to put this in contrast, the multiple of earnings, the average multiple of earnings of the 30 stocks in our UK fund is less than 6. And in the global fund, it's less than 9. Now that's cheap. That is very, very, very cheap. So it really is a bit feast or famine on that in the market at the moment. And the view we take is that these very, very expensive tech stocks, those prices are not sustainable. And whilst we're indirectly exposed to them through some of the positions on the US market generally, particularly as we use futures for liquidity, we've been gradually building up positions in these much, much cheaper stocks over the last few months. And that's been a lot of work that we've been doing on team during the summer. And you really turn up some little gems.
Gary, you've touched on government spending and how it's been immense. It's been helping keep the country together, keep it stable. And you're going to take a look at how that might impact on future generations at some point in the near future?
Yes, I am going to look at its impact on future generations. And just in case anybody watching this is feeling a bit panicky about that outcome, I can tell you that the level of debt to GDP in this country is not excessive. The level of assets to families is incredibly high. We are a remarkably wealthy nation. We are a creative people. And I think the future is actually quite bright. And I will deal with that in a piece. And I think you can see how little concern the level of borrowing is to the market at the moment by the fact that it's willing to lend money to the UK government over 10 years at about 0.24, 0.25% per annum. Doesn't strike me that anybody's particularly bothered about the credit worthiness of the borrower when they're lending at those rates. But I will cover that, and I would say that it's good news. But I think what we need governments to do now is to say, right, we've done what we can with low interest rates. The next move is to start to look at infrastructure, start to invest for the future, start to deal with the climate, start to deal with energy issues. And I'm an optimist because mankind moves on, and I think that's good, and I'll cover that in the next piece.
Excellent, thanks Gary. I look forward to that. Well, thanks for your time and for the article this time round. I look forward to getting it out. Ladies and gentlemen, if you do have any questions, please let us know and we'll put them to the right people. Gary, thanks.
Thanks, Leo. Thank you. Bye.
Take care. Bye now.